In the previous video, we saw that how the value of a $100 investment in 1925 grows over time for 5 different asset classes. In this video, we want to learn how to quantify risk and return for stocks. So let's first define realized return. Realized return is the total return that is actually earned over a given period of time. So for example, realized annual return is how much money you gained or lost by holding on to a stock for a year. From chapter 7, we already know how to calculate the total return or the realized return for a stock. So we said that the total return would be the dividend that we get over a year or over a period of time, plus the difference between the purchasing price and the selling price, all over the purchasing price or our initial investment. In other words, the realized return is equal to the dividend yield plus capital gain yield over that time period. Okay? So here is an example that shows how to calculate realized return. Health Management Associates, HMA, paid a one-time special dividend of $10 on March 2nd, 2007. Suppose you bought HMA stock for $20.33 on February 15, 2007 and sold it immediately after the dividend was paid for $10.29. What was your realized return for holding this stock? So again, the realized return is equal to the dividends that we got over this period of time, which is $10 plus the difference between the purchase price and the selling price. So our selling price was 10.29 minus the price at which we bought, which is $20.33. And the whole, we should divide this whole numerator by the purchasing price, which was $20.33. So this, if you use your calculator, would equal to negative 0.2%. Okay, so the realized return for holding this stock is negative 0.2%. Okay, so we already knew how to calculate the realized return from chapter 7. But if we want to calculate the average annual return for a historical period of time, we need to calculate the arithmetic average for that investment. So if I have 10 or 12 observation for the last 10 or 12 years, I'm going to simply calculate the arithmetic average to get the annual return, the average annual return for that investment. So I'm going to use this formula, which is the simple formula of arithmetic average. Okay, and you should know that the arithmetic average return is appropriate when we want to estimate an expected return for the investment, not its historical performance. So the expected return is what we are going to expect at the time of investment on stocks or bond or any other asset class. So when we want to put our money in an investment, we need to know what is our expected return, and a good estimate for the future return might be its past returns. So the best estimates that we have is the average annual returns of those investment in the past. So here in this figure, you see the average annual return for 4 different asset classes. Small stocks, a portfolio of small stocks, portfolio of large stocks, including all 500 companies in the S&P 500, portfolio of corporate bonds and treasury bills. So this graph shows consistent result from what we have seen in the previous video. So small stocks gives us the highest return, had the highest return over this 90 years period of time that we saw previously, from 1925 to 2015. And the next highest return is by a portfolio of large stocks, and then corporate bonds, and then treasury bill.